The Momentum, Diversified Yield and Inflation-Linked Funds have both beaten inflation comfortably over the last 7 years. Fund manager Conrad Wood joins us to discuss the ability of his funds to achieve real returns in this current environment of low interest rates. So welcome, Conrad. Good to have you here. So we heard today with the interest rate decision, interest rates will remain low. Our analysts all say lower for longer. So tricky environment for you to find those returns.
It's an extremely tricky environment for you to find real returns as a fixed income investor. I mean, the temptation tends to be then to try and take more risk in order to achieve positive real returns. So we would caution against that. The two funds I've sort of put forward tonight, we think give you a good chance of delivering good real returns going forward for acceptable levels of risk. But it is very tricky. Could be worse. You could be in the US where for the next 15 years their bonds give you negative real returns. So at least we've got something positive going here, but not great for savers and for fixed income investors in this environment.
Conrad, just on that, the one bond, your funds in the intro said that both funds had comfortably beaten inflation over the last 7 years. The one inflation-linked bond, the annual return's been about 10%, and the other high-yield bonds are a little bit lower. What are you expecting? What are the different instruments you use in each portfolio, and what's the outlook for those portfolios going forward in terms of beating South African inflation?
So the Momentum Inflation-Linked Bond Fund is a specialist fund. It principally invests in inflation-linked bonds. So it's not going to be everyone's cup of tea. It's not a fund that you're going to put your entire savings into or your entire portfolio into, but it's a great fund to combine with some other asset classes. As I said, it principally holds inflation-linked bonds. So these are normal bonds issued by the government, issued by corporates, issued by parastatals. But instead of paying you a nominal fixed coupon, they pay you a lower coupon, and that is compounded by inflation. So you effectively earn whatever inflation turns out to be over time. So that's where you get your real protection from. So these bonds do very, very well in medium to high inflationary environments because you're being paid inflation on top of your fixed coupon.
Okay, and in terms of the other fund, that fund has a slightly different mandate. It can invest in fixed listed property, and you can also take a component offshore. Is that something you've looked at because of with the inflation, with the interest rate environment overseas being so low? Has it been worthwhile to take some of that money offshore? Yeah,
so the Momentum Diversified Yield Fund is in this flexible income sector that has caught fire of late in fixed income markets. And that's essentially just flexible fixed income funds where managers have full discretion to use any of the different fixed income asset classes in trying to create these real returns going forward. So we look to credit, we look to listed property, inflation-linked bonds, nominal bonds, and some of the funds have this offshore component of which ours does. Offshore exposure in a domestic fixed income fund is always quite tricky because you're going to introduce some currency volatility to the fund. And a domestic investor that wants exposure to domestic interest rates is not always happy to have currency volatility in the fund. You might do very well in domestic interest rate space, but then a currency move sort of blows you out the water. So, we tend to limit the amount of currency risk we take in the fund. So we do go offshore looking for real yield investment opportunities, of which there are a couple around, but we normally try to hedge out the currency risk so that you don't have this volatility in the fund, but you get some diversity of being offshore in the fund. So we've used it to varying degrees of success. The rand has been stable to strong over the last couple of years, so having currency risk offshore would not necessarily have been the best thing to do over the last couple of years.
Listening to your description of the two funds, so the Diversified Yield Fund sounds rather exciting. You have the chance to trade in any instrument, whereas the inflation-linked portfolio sounds, I could probably run that portfolio, I suspect.
You do a better job than me.
So how would the returns compare? Are you getting higher returns from the Diversified Yield Fund?
Look, over time, the Diversified Yield Fund should give you higher returns because it's got a wider universe to invest in, and it can take a little bit more risk. The issue with the inflation-linked bond fund is just inflation-linked bonds have had the perfect storm. So they've done really, really well, doing comfortably double-digit returns over the last couple of years. That's been twofold. Inflation has been relatively high, 5-6% in South Africa. But the main return has come from yields falling. And as yields fall on fixed income instruments, because of low growth, so the capital gains from these bonds goes up. So that's why these have done very, very well. But if you want a rough indication of what inflation-linked bonds do over time, it's essentially your real yield, which is around 2–2.5% plus whatever inflation does. So if inflation is 6% in South Africa, add on 2% real yields, you're looking at 8% roughly total return from these things over time. In an environment where yields fall, you'll get a little bit more than 8. Like now, we've got 10–11% out of them. In an environment where real yields go up, you'll have some slight capital detraction. Whereas the diversified yield, as I said, looks to various sources in the fixed income market, and that should beat inflation comfortably over time.
Conrad, just on that diversified yield fund, what is the case for listed property? Because we know that it's benchmarked to the kind of investors compare the yield on listed property with the 10-year bond yield, government bond yield. So they kind of move in tandem with one another. Is that an area of attraction for you at this point?
So the case for listed property is an interesting one. It's been the best performing asset class for the last year or two. It's done, total returns, north of 20%.
Yes.
So, your gut feel is to take some profits and bank on any exposure you have had in the fund. You make a very good point. You need to only be bearish on listed property when you think bond yields are going to go up. When bonds are doing well or bonds are stable, listed property has an underpin to it, because these are cash flows that are coming in, and you price those off interest rates. So when interest rates are stable, it does well. There's also an equity component to listed property, obviously linked to the real economy, linked to the re-rating or de-rating of equity markets. So it's a difficult one to get right. There's some moving parts, but we're fairly constructive on the prospects for bonds going forward. While the real economy is starting to disappoint, that's a concern. We think there's enough of an underpin in listed property, for returns to be fairly decent. It's not going to do the 20% again. Of that, we're fairly convinced. But, to beat cash or to give you a positive real return over the next, say, 12 months, I think listed property, not a bad place to push your luck in at the moment.
Okay.
Conrad, what about corporate bonds? We seem so fixated with sovereign bonds, government bonds, various at maturities. Corporate bonds, there again, if people invest there, they tend to focus on the financial instruments.
Yeah, so corporate bonds would be a big part of the diversified yield fund in terms of its return and its performance. We hold very little government debt in that fund because you're getting paid a much higher yield to go into corporates, parastatals, banks, etc. So
you diversify, they're not just the banks.
You do have. Yeah, we go right out into different sectors, and the corporate market in South Africa is fairly developed. So you've got quite a choice. The portfolio probably has 25 to 30 different individual corporate and bank exposures in it. So yields are good. They still are suffering from the overhang from the global credit crisis, where spreads and yields on corporate debt blew. It's a little bit counterintuitive at the moment. When the economy is not doing well, you wouldn't expect corporate debt to be a great place to go and sit, because then how are corporates going to pay you back your money? The irony is they've sort of guarded their balance sheets so much in this environment and hoarded cash that they are very good credits at the moment, and you as an investor are getting paid a good spread. So we like corporate bonds. We're heavily invested in them. You're getting up to 1.5% above government yields at the moment for investment grade quality corporates, and we're very comfortable being invested in them.
You spoke earlier about the listed property sector, but now the property companies are also coming to the market with corporate bonds.
Look at, so, as I said, the market's fairly developed. So as an investor, you do need to discriminate between which sectors of the corporate market you want to be in. So the listed property guys have flooded the debt capital markets by issuing debt. There's also the unsecured lending guys, your Ables, your Capitec, your Bayports. That's very sort of topical at the moment. Some of the parastatals, there's Sanral. We've just spent the whole day today watching the court outcome with great interest. So all of those sectors are available to you as an investor. They all pay varying yields. You need to assess the risk you're taking in investing in them versus the yield you're getting. And that's what our credit analysts do and our portfolio managers do. And yeah, interesting space.
You kind of indicated before the show, Conrad, that you guys were watching the MPC decision with sort of bated breath, and Jill Marcus kept you interested right up until the end there. You thought you might have been getting a cut. What's your view on interest rates going forward, and where does that leave the yields that you expect to earn in the future? Yeah,
so the view on interest rates is crucial for both of these portfolios. What they do to interest rates will drive returns on these portfolios. I just think there's such a lot going on at the moment in South Africa and in the world. We've had, QE and the European debt buybacks, Japanese QE, China slowdown, and then all of our domestic issues. I just think there was too much on the go for them to have conviction to cut again. But I think behind the scenes, there's an inherent desire to try to play as much of a part as they can in helping this economy get back onto its feet. It's data dependent, and they're going to need to be one or two triggers along the way, but I wouldn't be surprised if another cut comes back onto the radar screen, because what I've seen in the global economy and these interventions that are going on, none of it fixes the fact that economies are broken and that there's going to be no economic growth. And that's Jill Marcus's biggest fear. As a small open economy that exports commodities essentially, China, the Europe and the US are struggling at the moment. Growth story benign. They could very well go again, which is not good news for savers, but it'll generate good news in these fixed income portfolios.
And just something, before we finish off, just to touch on something that you alluded to earlier, African Bank and some of these retailers that are selling on credit. Is there a credit bubble developing in South Africa at this point?
Sure. I mean, if you go on the strict definition of a bubble, I think the word's too easily used, and people are too quick to call things a bubble without really sort of understanding the dynamics. Bubble for me is mania and floods of money into it, and the growth has been strong in unsecured credit, and it cracked a mention in the MPC statement today. 30% growth year on year. Our view is that it's a risky segment. There's no doubt about that. These institutions that are making these loans are very well capitalized and very well run. This is our economy getting up to structurally more acceptable levels from credit penetration perspective. We watch it very closely. We would be hesitant to lend the likes of Able and Capitec money for 7 years. But for 2 or 3 years, the yields they're paying you now and the quality of those businesses and those balance sheets, if you're just wary of the risks and you keep an eye on the performance of those books, certainly not a bubble. Low quality credit space to operate in, but you get paid for doing that, and we're quite happy to have that as a part of our portfolio to diversify.